This is Richard Kapsch, Managing Director of Pride Holdings in Schaumburg, speaking to you from Schaumburg today. Today we're going to cover options and the basic principles of options. Now, before we get into that, though, I want a little bit of a background. When you're trading, let's say Forex or any other particular market, today you've really only got two alternative trading strategies. If you're bullish on a particular market, you go long, or you buy that particular market or currency. If you're bearish, you sell that currency. And then if you don't have any idea where the market's going, the best strategy is to stand aside. So essentially all you've got is two strategies that you can employ. One of the advantages to options is that you've got multiple strategies. It gives you a lot more flexibility, and there are strategies, many strategies for every type of market condition, whether the market's going up, down, or sideways. Or if you have no clue where the market's going to go, there's still option strategies that you can employ. Many years ago in Hollywood, there was a movie called The Graduate, and I don't know if anybody's ever seen this, probably before you were born, but it came out in about 1969, starring Dustin Hoffman. He was a guy that had just graduated from college, and he was at a party, his graduation party, and some man came up to him and said, "I have just one word for you," and he said that word was plastics, meaning that plastics was the future to be involved in. If I could reshoot that movie today, I would just say one word to that person and say options, because options have so much flexibility and different strategies that it has many advantages over outright trading. Today, now before we talk about what we're going to do today, some people have a certain idea about options that they're an extremely risky strategy, and they can be depending on the strategy that you employ. But we're going to talk about some strategies next week where if you know what you're doing with options, options are safer than regular trading. Okay, so let's take a look at the basics of options. There are two basic options that you can employ, a call option and a put option, and we're going to talk about the differences between the two. And they're very similar, but there are some basic differences. In the case of a call option, the holder of that option has the right to buy an asset. So you have an option to buy that particular asset, and it's when you purchase the option, it gives you the right to buy this asset. Remember, there's two steps here. One is buying the option, the second is buying the underlying asset. You buy at a prearranged price, and you have a certain date that option is good for. Now, to acquire this option, you have to pay an upfront fee. But the advantage to that is once you pay that upfront fee and purchase the option, you have no further obligation to buy that particular asset. Okay, so that's very important. The advantage to that is once you pay that upfront fee, that's it. If you purchased an option, there are no further margin calls involved, which is one big advantage in these particular trading. I think everybody that trades hates margin calls. Here's an instrument where once you purchase that option, you get no more margin calls. So reviewing that, the call option, the holder of that option has the right to buy an asset at a prearranged price by a certain date. And he pays an upfront fee for this option, but once he's paid that upfront fee, he's got no obligation to do anything else. He can just simply let it expire if he wants, or he can and then go on to some other particular trade. But again, the big advantage is no margin calls. Okay, put option is the mirror image of the call option. In this case, the holder of that option has the right to sell an asset, also at a prearranged price and by a certain date. Again, like the call option, he pays an upfront fee, an out-of-pocket cost to acquire this particular option. But once he purchases the option, he's got no further obligation regarding doing anything with that particular option. And again, the big advantage is to both the put and the call. When you purchase a put or a call, you get no margin calls. So if you're bullish on a particular market, the simplest strategy to employ would be to buy a call option. If you're bearish on the market, the simplest strategy is to purchase a put option. The call option gives you right to buy an underlying asset. The put option gives you the right to sell an underlying asset. Okay, there are some terms regarding options that we should go over. In one case, the basic term is exercise. And what exercise is the process of converting that option to an underlying position in the asset. So when you decide to take that option and buy the underlying asset, you are exercising that option. Okay, the price at which that conversion is done is called the exercise price, or also the strike price. And we'll go over an example of how these fit in particular options. The third important term is every single option has an expiration date. They don't go on forever, but expire on a particular date. So if you're going to do anything with that option, you have to do it before the expiration date. The expiration date is key to that option. And finally, the upfront fee that you pay for an option is called the option premium. And it's kind of like buying an insurance policy. When you pay for that insurance policy, the upfront fee you pay is called the premium. And the same thing when you purchase an option, the upfront fee is called the premium. So we'll be talking about strike prices and premiums when we talk about these particular options. Again, when you're purchasing an option, your only out-of-pocket cost is the premium. There is no additional margin call ever required on that particular option as long as you purchase the option in the first place. Next week, when we talk about some of the option strategies that may involve selling options, then they entail margin calls. However, most of the strategies that you're going to be interested in are simple purchases of calls or puts, and in that case, all you pay is premium out of pocket, no further margin call. Everybody with me so far? No questions? Roxana?
Initial, na?
So can we
Away from the computer. Can we do what?
sir, the concepts are clear.
The what?
The concepts are clear. You can proceed, sir.
Okay, good. Okay, there are two classifications of options based on when during the life of that option you can exercise. The first and the most common style option is what we call an American style option. In an American style option, you can exercise that option at any time prior to expiration. So if you want to convert your option into an underlying futures contract or currency contract, you can do that at any time, even if it's only 1 minute after you buy the option. Second style of option based on expiration date are European style. European style were the type of options that were originally created about 45 years ago, but these are extremely rare nowadays. Most options that you run into are American style options. In the case of a European style option, the only time you can exercise that is on the expiration date when that option expires. So you can see it gives you much less flexibility. Now, a little bit later, we're going to talk about binary options briefly. Binary options are an example of a European style option which can be exercised on the expiration date. The problem with a binary type option, the trading date and the expiration date are usually the same. But most of the options we're going to run into are called American style options. Okay, let's take a look at an example of a call option. Let's say we've got a British pound 140 call. That expires in 4 months from today. And let's say the market price is 138. In other words, $1.38 per pound. And the premium for this call, which you know up front, is 2 cents per pound. What that call gives you the right to do is to buy British pounds at 140. Now, when the market price is 138, you're not going to buy them at 140. But if the market price goes up to 148, then you're going to be, then it's possible to exercise that option and buy those British pounds at $1.40 and make a quick 8 cents per pound. The premium at 2 cents per pound is the upfront fee, which amounts to 2 cents per pound. Okay. Now here's an example of a put option. Let's say it's a Japanese yen 105 put with an expiration 3 months from today, and at the time you're looking at this option, the current market price is 104.50 with a premium of $0.0001 per yen, or 1/100th of a cent per yen. This put gives you the right to sell Japanese yen at 105 yen per dollar, and for that you pay an upfront fee of 1/100th of a cent per pound, per yen, I mean. Let me go back briefly to the British pound quote. We haven't talked about the size or the quantity that backs up the particular call. If you're trading a call that's listed on a futures exchange, the quantities are all standardized. In the case of the British pound call, which is traded on the Chicago Mercantile Exchange, every British pound call calls for 62,500 pounds sterling. Okay, so if you buy one British pound call on the Chicago Mercantile Exchange with an upfront fee of 2 cents per pound, it comes to about $1,250 to buy that particular call. Now, at a $1.40 per pound, that's about 80. That underlying contract is worth $87,500. So an upfront fee of $1,250 amounts to about 1.4%. So you're talking the similar margins, $1 on 100. Now, in addition to calls or options that are traded on the exchange, there are also over-the-counter options which do not have standardized quantities. And these are available through banks and other firms that write these particular options. In the case of the put option, each Japanese yen contract or put calls for the purchase of 12,500,000 yen, and at a premium of 0.0001 per yen, that also amounts to $1,250. Now, at 12,500,000 yen at 105 yen per dollar, is worth $119,000 per contract. So in this case, the premium quoted at 0.0001 is actually a little bit less than 1% or less than $1 per 100. Does everybody understand what we've talked about so far? And no questions? Okay. Now, so far we've talked about purchasing options, purchasing calls, purchasing puts, and we've talked about a number of advantages of these options, specifically flexibility, and also the fact that there's no additional amount of funds to pay once you pay the basic premium. There's no further margin calls. So you might be asking yourself the question, well, if I can buy these things and I have all the advantages on my side, who is going to sell something like that to me? And the answer is there are professionals. Most professionals that trade options sell options rather than purchasing options. And again, we'll talk about some strategies next week why they do this. But one of the key points of an option is when somebody sells an option, the only amount of money he can make on that option is the amount that was paid for the premium. Since you as the purchaser don't have to put any more money up, you know, obviously you can't lose any more than you've actually paid out of your pocket. So the person that sells the option, the maximum amount he can make is the amount he collects as premium. So you might say, well, why the hell would he do that? And the answer is, like I said, he's got other strategies, and he does it in large quantities by selling these premiums. But the one key, when he prices that option, he wants to make sure that the premium that he sells the option for covers all the potential risks, or substantially covers the risks that he might encounter while that option is unexercised or still open. So what we want to talk about now are some of the factors that are built into that option premium price that you should consider as a purchaser and the seller builds in to compensate him for the risk that he's entailing by selling that particular option. And the first factor we're talking about is something called intrinsic value. Now, back when we gave that example of the British pound call, we said the strike price, the exercise price of that pound was $1.40, 140. And at the same time, the market price was 138. So now, if you went to exercise that option at 140 while the market is at 138, you'd be immediately losing 2 cents per pound. So you, as the option purchaser, are not going to exercise that option while the market price is below the strike price. However, if the market price goes up to 145 or 148, then you've got some built-in profit, and it's worth your while to exercise that option. So what we want to calculate when we're looking at a particular option is what the built-in profit is at the time the option is sold. In the case of a call, it's the difference between the market price and the exercise price, where the exercise price is less than the market price. In the case of a put, the exercise price has to be above the market price to have a built-in profit. So that, yeah, go ahead.
When you say built-in profit, I mean, I will be able to exercise the call option only when the market price is higher than the exercise price. This is in the case of when I buy a call, right?
Well, you can exercise it whenever you want, but you would not exercise it unless the exercise price was below the market price. If the exercise price is above the market price, you as the call purchaser would not exercise it. Okay, however, if the exercise price got below the market price, so let's say if the exercise price was $1.40 per pound and the market price was $1.45, you can immediately exercise that option and make 5 cents per pound. Okay? You understand?
Yes, sir.
Same thing with the put. Let's say it was a British pound put and the exercise price was 140. That gives you the right to sell British pounds at 140. You would not sell them at 140 if the market price was at 142, because you're better off selling them in the open market. So if when you purchase the option, if there is a built-in profit, let's say in the case of the call of 5 cents, the person selling you that option is not going to give away those 5 cents. He's going to charge you at least that 5 cents difference in the call between the exercise price and the market price. So to prevent you from saying, well, here's an option I can buy for 2 cents and immediately make 5 cents on it, it's a no-brainer. In this case,
okay,
we say the option has intrinsic value, and the intrinsic value is equal to the built-in profit. Now, options that have intrinsic value, positive intrinsic value, are called in-the-money options. And those are the options that can be immediately exercised for a profit, all other factors being considered equal. Out-of-the-money options are those that you would not exercise because there's no reason to exercise. These have no intrinsic value. So the first factor that we're looking at in determining the premium on an option is what is its intrinsic value. If there's a built-in profit difference between the exercise price and the market price, then the intrinsic value is going to be equal to that difference. And the person selling the option is going to build that difference into the price or the premium that he's willing to sell the option for. If it's an out-of-the-money option where, in the case of a call, where the exercise price is above the market price, or in the case of a put where the exercise price is below the market price, those options have no intrinsic value, and they're called out-of-the-money options. So there would be zero charge for the intrinsic value in determining the premium of that option. Everybody got that?
Yes, sir. So far clear.
So built-in, we're almost clear, right? Built-in profit equals intrinsic value. Okay?
Yes, sir.
All right. The second factor affecting option premiums is the time value. Now, if you're a person selling an option and there's a long time between the time you sell that option and the time the option expires, there's a lot of time when the underlying asset, if it's a call, can rally and cause you to lose money between what you have to sell that option for or sell that call for and what the premium that you collected for selling it. So the greater the time to expiration, the greater what we call the time value. The further to expiration, greater the time value. As it approaches expiration, that time value decreases because there's less risk of less time for that option to jump up and get exercised. And this graph on the chart shows the relationship between the time value of an option and its expiration. And you'll see that as it approaches expiration, it's continually decreasing because there's less and less time for the option purchaser to exercise that option. And then when it gets to about 30 days to expiration, it decreases extremely rapidly. So, and to the point where at expiration, the time value is equal to zero. So far we've got two factors we've considered in determining option premium. One is intrinsic value, the second is time value. Okay, the third factor that affects option premiums has to do with volatility. And here on the chart, we've got two hypothetical charts that tracking IBM stock over a 6-month period. Okay, and the top one, we've got extremely low volatility where the stock trades between roughly 102 and 107 over that 6-month period. So we've got a very, very flat graph that shows very little volatility. The bottom graph shows a hypothetical movement where it moves from 105 up to 117, back down to 96, up to 122, and then back down. So the second chart is much more volatile than the first chart. So when you look at these two, you might say, okay, if I'm selling, let's say, an IBM 110 call and the market is at 105, based on the historical movement of the stock or the volatility of that stock, which graph is more likely to get an option that's exercised? And the answer is the bottom one, because there's more of a chance, the higher the volatility, the greater the chance that the stock can jump up and get exercised. Where on the top graph, we've got very little volatility. And we can see over the last 6 months, it's never gotten to 110. So that the odds of it jumping up in the next 6 months and getting exercised are much lower. So the person selling that option, that call, would charge a higher premium based on the volatility in chart B than he would in the chart based on the volatility in chart A. So the third factor, the higher the volatility in a particular underlying asset, whether it's a stock or a currency or gold or whatever, the greater that seller is going to charge for that particular premium. So the greater the volatility, the greater the premium. So in looking at a premium, there are three major factors that contribute to the magnitude of that premium, or what you would pay as an option purchaser. The first is the intrinsic value, which is equal to the underlying profit, built-in profit, at the time the option is sold. And if there is no built-in profit, the intrinsic value is zero. It can't get less than zero, but it can certainly get much greater than zero. The time value is the greater the time to expiration, the greater the contribution that time value makes to the total premium. And then the third is the volatility. So if we had an option that was, let's say, 10 cents in the money with 10 cents profit, and let's say 6 months to expiration in a highly volatile market, you pay a much higher premium than you would for one that was, let's say, did not have a built-in profit, was close to expiration, and had low volatility. Okay, so you might ask the question was, how do they determine this? One of the things you're not interested in is calculating this yourself, because that's what we've got computers for, and computer models. What you're primarily interested in is what the total premium you have to pay, because that's what you pay. And then when we go back to determining reward for risk, you're risking that premium. That's your maximum risk, and you want to make sure that the potential reward is greater than that premium. But you might still ask your question is, how do they know what these options are? Reminds me of an old story about hang on one second. Many years ago in the United States, anybody that's ever followed baseball, there's a very famous baseball player named Yogi Berra, who's made a number of statements or quotes that are sometimes senseless but very funny. But one time he was asked about an invention. He said he thought the greatest invention ever made was a thermos bottle. And the thing about the thermos bottle, it keeps cold liquid cold, and it keeps hot liquid hot. But the key question about the thermos bottle was, how does it know whether to keep it cold or hot? And in here, what we want to know is, get some ideas, how do we know how these things are built into the calculation for total premium? Back in 1973, the first exchange-traded options, in fact, the first options that were traded anywhere, were traded in 1973 on the Chicago Board Options Exchange. And two economists, Black and Scholes, I think Black's first name was Myron, or maybe Scholes' first name was Myron. But the two of them got together, and these were two academic mathematical economists, came together and created something called the Black-Scholes model for valuing a call option. And this is how we take those three factors and determine the option premium. This was the first model that was created for calculating the premium of a particular option. And I'm not going to read this to you, but you can see where the value of a call equals that number. It looks like something out of a physics lab. But the important thing is the factors that went into this particular model were the stock's current market price, PE, the exercise price. The problem with the Black-Scholes model, it was created for stock options that pay no dividends and only apply to European style options. And as we said earlier, most options today are American style options. So the Black-Scholes model isn't as calculated, but there have been some advances in these calculations. There are two other models, the Cox-Rubinstein model and the Whaley model, that do take into account American style options and calculate premiums for futures and foreign exchange contracts. So, you know, if you have that particular model, you can calculate, you know, what the premium should be for a particular call, and it can go into your decision as to whether or not to buy that call or not. Okay, the last thing I want to talk about is a relatively new development in the options model, and these are binary options that you hear pushed a lot by various trading firms. And basically what a binary option is an extremely short-term option. By short-term, I mean term to expiration. That term is usually less than 1 day, so it's almost like day trading an option. If you buy that option, you know that it's going to expire that same day, usually maybe within 5 minutes or 10 minutes. And the way you would trade that particular binary option is basically a bet that the market will go higher or lower within the time left to expiration, whether it's 5 minutes or an expiration. The shorter the period, whether it's 5 minutes, the premium is going to be less than an hour. But in either case, it certainly doesn't move on fundamentals. It's simply a bet like going into a slot machine or blackjack table. And you're betting that the market will go higher or lower in a short time period. So it's really not a trading thing. It's just, to me, it's a form of legalized gambling, or maybe illegal gambling, depending if you're trading in the United States or not. But those are binary options, extremely short-term options, and you know, it may look like there's tremendous profits that can be made, but remember, when somebody's selling an option, he's always pricing that option so that his risk is going to be commensurate with the reward that he gets for it. He's not going to be giving them away, so just be cautious when you use those options. Okay. That's all I was planning on covering. Does anybody have any questions on any of the things we covered this morning? Or this evening? Next week, next Wednesday, we've got another webinar planned. We're going to go over options. Yeah.
So there's somebody who would like to have a question. Just hold on for a minute, sir.
Okay.
Sir, that binary option is a blend of American and European style that contains both the qualities.
What was the question? Some difference between American and European style options?
Binary
You were
option
cutting out a little bit.
Yeah, is a blend of the two, American as well as European style.
Is the plan of the two? What do you mean?
Blend. When you mix the two, the American and the European, so you get the binary option.
Well, I mean, it's sort of an American in the fact that it's a combination because the expiration date is the same as the trading date, but you can exercise before the actual expiration. So in that case, you might describe it as American style option. The key thing to remember, the key thing to remember about the options is that they're extremely risky, and that the person selling you that option has priced that premium high enough so the odds are always in his favor. It's like going to a casino. You know, you can make money on any one particular bet, but in the long run, the house is always going to make money because he's built the odds to his favor. And the same thing with the binary options.
Thank you.
Okay. Anything else, Roxana?
Nothing from my end, sir.
Okay, like I said, next Wednesday, what we're going to talk about are some option strategies, that different ways, different strategies you can use for different market conditions in terms of trading options, and ways that you can manage your risk other than just, you know, betting the premium. But we'll talk about that next week. We'll talk about option strategies. So I look forward to talking to you then. Okay, thank you.